Have you ever wondered how the wealthiest investors unlock the exclusive opportunities that most everyone else can't touch? It starts with something called accredited investor status, but that's more than just a label. It's a gateway to a whole new level of investing. So what is accredited investor status? Accredited investor status is a definition set by the SEC to ensure that you either have the financial know-how or the ability to take on extra risk as they define them. There are three ways that you may meet the accredited investor status. The first is through your income. You must have, as an individual, at least $200,000 in gross income for each of the last 2 years, or $300,000 as a couple. The second is through your net worth. You must have at least $1 million net worth, excluding your primary residency. And the last is through various professional certifications related to finance. I strongly recommend that we mostly focus on meeting the status through the net worth. The reason is because you need to have at least something that you can invest with. And many of these style of investments have pretty high minimum investment amounts, and you're also going to want to be pretty diversified because these tend to be a little bit longer term investments. By having at least $1 million net worth, that frees you up to be able to invest in everything that you need to be diversified and have a complete portfolio. So why does this status exist? Well, it's not just about exclusivity from the SEC. The SEC originally built this status in kind of as a safeguard against risky and unregulated investments. You may be asking yourself, if they're that risky, then why bother? What's the use of investing in these investments? The biggest thing is really the opportunity set. So currently the private markets account for about 86% of the overall market equity out there. And over the last few decades, the number of publicly traded companies has been going down. Not only that, the time for a company to go from being a brand new startup to being listed on a public exchange, it used to be closer to 4 years back in the late 90s, and now it's a lot more like 12 years of the company existing before they actually go public. That means the IPO has grown substantially, and so these companies have already made a lot of that early money that they expect to make long before they ever go public. The private markets aren't just about brand new startups either. They're not just venture capital. And if you want to think about it this way, the most recent example is Twitter actually just went private just a few years ago. And so Twitter is something that you can still invest in, but it's done through the private markets, not through the public equity anymore. And so there are very large, very successful companies that are out there that are on the private space that you cannot invest in without achieving this status. The main reasons that I really want to drive this home is you get access to a lot more growth because you're getting in earlier. You're getting much better portfolio diversification just because they have less correlation to the public markets and the way that it all works. And generally, there's higher returns related to investing in these companies. Data that we have dates back the last probably 25 years. Private equity has averaged somewhere around 10 to 12%, whereas the S&P 500 has been somewhere around 7 to 8%. So what type of investments are out there in the private space? Well, there's private equity, as we've already discussed. Private equity can include everything from startups, such as venture capital. If you want to think of venture capital as kind of like the guys on Shark Tank, you're essentially there as one of them trying to invest in somebody else's company and their passion, and essentially the funds that you would be investing in, they're out there doing exactly that and helping them get their company going and moving. Venture capital tends to be very, very risky because almost every company out there within the first year or three, 60 to 90% fail between that time frame. But as I said, private equity doesn't just include startups. It includes much larger cap stocks that are out there. Some of the most famous probably are Elon Musk companies. Elon Musk has SpaceX. That is something that is only traded in the private markets. His Twitter was a public company, but when Elon Musk bought it, he took it to be a private company. And so you can only buy it in the secondary markets of private equity. There's also something called private credit. There's lots of different things that go into private credit. Probably the most common is direct lending opportunities, where they're lending money to these private companies. And so instead of being a publicly traded company that's going out and issuing bonds, they're a private company, and so they're usually looking to banks. But banks have become a much smaller player in that space, and so investors have filled that role, and so they've become essentially investors in debt, the same as if you were buying a bond. A little bit more risky, but a lot more reward. Real estate is one of the other big ones that a lot of people think of in this space. There are publicly traded real estate companies called REITs, if you will. They are listed in the public exchanges, and you can go out and invest in those. You can invest in funds that only buy publicly traded REITs. Privately traded REITs are going to act a little bit different. They're going to be a little bit less volatile. They're going to spit out that income. It just depends on what type of real estate you're investing in. You might be in a core or a core plus, which is essentially looking for income from the investment. You might be in a value add, where the fund is going out and they're essentially trying to flip apartments, and they're all doing it with your investment money. And so you're kind of betting on the managers to be able to go out and do what they do. And the reason you would do that is because they can provide a whole lot of growth and a whole lot of investment return for your money. Now that we talked a little bit about why we might be interested in investing in the private space, we really do need to address the risk associated with private market investing. It can be a risky endeavor, and it really needs to be discussed. One of the big things is liquidity. You put your money inside of a private investment, and chances are you're not going to be able to get it back anytime soon. Some of the larger funds, the way they do it is you commit to having your money go into their fund, and they have up to 3 years to call that money. And when they call the money, you have to have it available within just a few days to send to them. And they invest it over a period of time. And then that money stays invested for, could be up to 12 years before they start giving that money back to you, and you start seeing the return. They have something called a J curve with those types of funds, where you essentially have lost money because you're paying fees associated with the investment before your returns start going up. And those returns are never guaranteed. When you're dealing with the private space and you're dealing with real money and real investments, lots of things can happen, and you start seeing very big losses very fast. And that's just something I really want to stress. These are not risk-free investments. No investment is ever risk-free, but these do carry some special weight that we really need to consider. There are other styles of investments that invest in private equity space and private real estate space that provide a little bit more liquidity. There's something called an interval fund, where you're essentially committing to your money, and it can be invested right away, and it's getting invested in things that are not liquid. These things are not easy to sell, and so they provide so much liquidity. You might be able to sell out of these funds once a quarter, and maybe only 2 to 5% of your overall portfolio value inside that investment, because if everybody wants their money out, they're not going to be able to accommodate you, because the money inside of the investment is illiquid, and they can't just sell it without taking a huge loss for everybody. And so you might have to request your money the next quarter and the next quarter and the next quarter until it gets to be a small nominal amount before they can get your money out. And so I really need to stress that these are long-term investments. Now, I encourage all of my listeners and watchers to consider any investment to be a long-term investment. We don't want to be jumping in and out of markets and trying to time them. It's just not good practice when it comes to investing. The other big thing with private equity space is really the dispersion of returns when it comes to the funds that you're getting in and the managers that you're using. When you jump into the public space and you buy this large cap fund versus that large cap fund, the difference in average return over the last 10 to 20 years between those two funds typically isn't that great. There isn't a whole lot of dispersion between the funds. The private space is a whole lot different. There is a massive, massive dispersion away from the average. Earlier we talked about private equity might be, 10 to 12% on average over the last 25 years. Well, some of the better managers maybe have been up in the upper 20% return on average. Meanwhile, some of the worst managers might have lost money over that same time frame. And so we really need to be careful on who the manager is, what the fund's doing. There's a whole lot goes into it. And so that's why I strongly recommend nobody invest in the private equity space unless they absolutely know what they are doing and probably have a financial advisor and somebody else also taking a look with you, because there is that risk associated with it. Anytime you're investing in this space, it's typically a small percentage of your portfolio. You're still keeping most of it invested in the public equity space. I think the average investor, somewhere between 10 and 30% of a portfolio might be invested in the private equity space. Thank you for joining me on this episode of the Storybook Adventure. If private investments are something that interests you and you would like to explore this further, please do reach out. I absolutely enjoy the private equity space, the private real estate space, and looking at how these can fit inside of all of my clients' portfolios. Accredited investors are somebody that I really enjoy working with. I'm here to help everybody that comes in front of me to build kind of the better life and the life that they want to live and have always envisioned. It's not just about the investments. The investment just a tool for you to be able to do the things that you want to do. Until then, thank you very much.